The S&P is sitting at all-time highs, but don't get complacent. There's a lot of churn under the surface. This is a breakdown of the two-speed market and how to position for the next couple of weeks. Here's the game plan. We'll start with the market pulse, then look at the risk radar. From there, we'll zero in on some catalyst-driven stocks, lay out a few scenarios, define the bull and bear arguments, and finally, look at some potential option structures to act on these ideas. Let's get to it. So what's the feel of the market right now? Well, it's really a tale of two different tapes. On one hand, you've got what the broad indexes are doing, and on the other, you have what's happening to individual stocks. They are not telling the same story. And this slide lays it out perfectly. Look left, the S&P 500 is making new highs, and the VIX is just asleep, hovering between 15 and 16. That screams low fear. But then you look to the right, and you see single stock chaos. Names are having these extreme event-driven moves on things like earnings or a new partnership. This is the core tension in the market you have to understand right now. So what's driving this disconnect? Let's pop the hood and take a look at the risks that the calm surface of the market seems to be ignoring. There are three big items on my radar. First, fiscal paralysis. The government shutdown is dragging on and it's chipping away at GDP growth, about 0.1% every single week. Second, you have geopolitical friction with China. These trade tensions could easily disrupt supply chains for critical things like rare earth minerals and pharma. And third, the situation with Russia and Ukraine. Any calls to escalate sanctions introduces a ton of volatility for the energy and defense sectors. Which brings us to the key question, right? With these risks clearly out there, why is the VIX so low? Why does the broad market seem so calm? It suggests a level of complacency that traders need to be very aware of. 16. That's the number. The VIX is telling us the market is comfortable. But this gap, this divergence between the underlying risks and the market's calm exterior, that's where we can find opportunity. So if we can't trust the broad market index for a clear signal, we need to zoom in on where the real action is. And that's in individual catalyst-driven stocks. First up, PayPal. This stock has been out of favor for a long time, but its new partnership with OpenAI could be a genuine game changer. This is more than just a press release. It's a potential shift in the fundamental growth story. The key thing to watch here is whether the stock holds its support levels after this announcement pop. Now, for a more speculative idea, Opzelura. This is a classic squeeze setup. You've got exceptionally high short interest, meaning a lot of people are betting against it. But they have 4 conference presentations coming up. Any positive news could trigger a massive short squeeze. And what's interesting is the unusual options activity we're seeing in the January 6th calls. Someone is positioning for a move. And if you're looking for something more conservative, take a look at Waste Management. This is a high-quality defensive company. It has a 21-year streak of dividend growth. The stock took a hit on a minor 1% earnings miss, a clear overreaction. Now it's approaching a key $200 support level and trading much closer to its 5-year average valuation. This looks like a potential value entry. Okay, quick pause for our standard disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. All right, so we've looked at the market and some individual names. Now let's talk about how to prepare for what might come next. Remember, the goal is to prepare, not to predict. I'm looking at 3 potential scenarios for the next 1 to 2 weeks. My base case is a sideways grind. The S&P holds its highs, the VIX stays below 20, and the single stock volatility continues. In that environment, you want to have balanced exposure and keep cash ready for opportunities. The bull case would be a risk-on breakout, triggered by something like a quick resolution to the shutdown. That's when you'd increase your long exposure and deploy that cash. And then there's the bear case, a risk-off shock. The shutdown drags, VIX breaks above 25. That's your signal to reduce your exposure, increase your hedges, and raise cash. So let's boil all this down to the 2 competing arguments that are really driving the market right now, the bull versus the bear. The bull thesis is pretty straightforward. Don't fight the trend. The S&P is at all-time highs for a reason. You've got positive micro-catalysts like the PayPal deal and solid earnings from companies like UPS providing fuel. The bear thesis, on the other hand, says that cracks are starting to show. Weak guidance from some companies could spread, we could see profit-taking in big tech accelerate, and any kind of geopolitical shock could cause this low VIX environment to snap back violently. Okay, now let's get practical. How could you potentially structure some trades around these ideas using options? Here are a few frameworks. For PayPal, if you're bullish on this AI narrative, a call debit spread makes sense, something like the November 65 by 70 strikes. The rationale here is simple. It gives you defined risk, it's cheaper than buying calls outright, and it lets you play a directional move. Your invalidation point is clear, a break below those post-announcement support levels. For the ab seller squeeze play, you're looking for an explosive move. So you could consider long calls or a wider call debit spread to capture that potential IV expansion. But I have to emphasize, this is a very high-risk setup. The invalidation is negative news from those conferences, your entire premium is at risk, so you should only be using a starter size position here. And finally, for waste management. The thesis here is to either acquire a high-quality stock at that $200 support level or simply collect premium while you wait. A cash-secured put is a great structure for this. For example, selling the November $200 put. This lets you take advantage of the drop in implied volatility after earnings and clearly defines your entry price. Your invalidation would be a decisive break and hold below that 200 level. And our final disclaimer. This is not trading advice, just a market update to keep you informed. Markets carry risk. Always trade your own plan, manage your downside, and verify all data for yourself. So, I'll leave you with this question. In a market where the indexes are calm, but individual stocks are not, what's the greater risk? Is it being complacent, or is it being too cautious? It's the central tension of this market, and something to think about as you plan your next move.